The 10 seconds before pressing the sell button. A behavioral finance and neurodecision analysis. There is a moment every investor recognizes. The position is open. The profit or loss is visible. The cursor hovers over sell. And then 10 seconds pass. Those 10 seconds often contain more psychology than the entire trade. 1. Time compression and emotional amplification. In high-stakes financial decisions, time feels distorted. Neuroscience shows that when facing potential loss or irreversible action, the amygdala activates, threat detection, stress hormones increase, cognitive processing shifts from analytical to emotional. Those 10 seconds may feel longer because the brain treats the action as consequential. The market is external. The decision is internal. That gap creates tension. 2. Loss aversion and prospect theory. According to Prospect Theory by Daniel Kahneman and Amos Tversky, people weigh losses more heavily than gains. If the position is in loss, selling makes the loss real. Holding keeps hope alive. If the position is in profit, selling locks in success. Holding risks giving it back. In both cases, the sell button forces finality. Finality is psychologically expensive. 3. Identity conflict. Pressing sell can mean different things. I was wrong. I'm taking profit. I'm giving up. I'm being disciplined. The hesitation reflects a clash between ego, fear, greed, strategy. Sometimes you are not deciding about money. You are deciding about who you are as an investor. 4. Anticipatory regret. In those 10 seconds, the brain runs simulations. What if it spikes right after I sell? What if this is the exact bottom? What if I miss the big move? This is regret aversion, the attempt to avoid future self-blame. Interestingly, waiting often feels safer because if it drops further, the market was bad. If it rises after selling, I sold too early. The mind prefers uncertain hope over certain responsibility. 5. The sunk cost effect. If you spend time analyzing, watching, and emotionally investing in a position, selling feels like discarding effort. The brain resists. I've held this long. I've endured volatility. It owes me something. But markets do not reward emotional endurance. They reward disciplined execution. 6. Micro-decision under pressure. Those 10 seconds are a microcosm of decision-making under uncertainty. Incomplete information. Irreversible action. Financial consequence. Social comparison, real or imagined. The body reacts as if facing a threat. In reality, you are executing a rule. But if there is no predefined rule, the decision becomes emotional improvisation. And improvisation increases hesitation. 7. Structured versus emotional selling. There is a key distinction. Structured sell. Predefined exit level. Risk-reward framework. Thesis invalidation. Portfolio rebalancing rule. Emotional sell. Fear spike. Panic reaction. Impulse. External noise. When structure exists, the 10 seconds are shorter. When structure is absent, the 10 seconds feel endless. 8. The hidden question. In those 10 seconds, you are really asking, am I protecting capital or protecting ego? Is this discipline or fear? Would I open this position today at this price? That final question often cuts through hesitation. Conclusion. The 10 seconds before pressing the sell button are not about timing. They are about accepting uncertainty, accepting responsibility, accepting imperfection. Selling is rarely comfortable, but markets reward process, not emotional endurance. Sometimes the hardest part of investing is not analysis. It is clicking once. When your system says it is time,